Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here to give you the best commentary about our property markets. Tina Howes is with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We are giving you a whole series explaining all things property finance, so stay tuned. Hello everyone, Tina and I are back in our series about property finance. I am excited about every video that we do, Tina, but this one in particular does really excite me because it is such a hot topic. We have this conversation so often with people. I dread to think you must have this conversation multiple times a day. It's all about interest rates. How important is your interest rate? Now, it is one of the most important topics when it comes to property finance. We've both been asked, I think, countless times over the year how important the interest rate is on your loan. And the answer, of course, is quite simple. It is important, but it is not everything. And there are pros and cons to everything in life. And what we're here to discuss are those pros and cons of really essentially going with or chasing rates, going with a very cheap online lender. No offense to them out there, of course, but I guess letting it drive you as your main motivator, going to a cheap lender, going to an online lender, because those kind of rates, those kind of loan products can be very problematic. They can have drawbacks that you may not have considered while you're chasing after that really cheap interest rate. So we've come up with, is it 10? My gosh.
10.
10. Yeah. 10, count them everyone, 10 reasons why you shouldn't necessarily just use the cheapest lender, right? So we are going to go through them one by one. Okay. Not necessarily in any particular kind of order, but the first one really is that they won't always keep that rate or that very cheap rate throughout the life of your loan. And Tina, go.
Okay, there is a bit of a trend that some of the really cheap providers have this great rate that gets you in the door, gets you to settle on the loan.
Reels you in.
Yeah. Now, and we're not just talking about intro rates here. We might just be talking about a standard variable rate that, you know, at the end of the day, rates move if they're variable. And so the minute we start to see rate increases from, say, the Reserve Bank and the cash rate goes up, that gives all the banks sort of permission, I guess, to in the market to then increase what their benchmark variable rate is. Now, often those really low-cost providers will then hike up the rates for their existing clients more so than what they would for their new clients. So they're left paying the penalty, and they just hope that you don't notice and you know, too busy to look at sort of potentially refinancing away from them. But it's a common trend from some of your really low-cost providers.
Yes. So keep that in mind, peeps. Number two. Having an office is an overhead, right? Having staff is an overhead in order to keep costs low. Or actually, I should let you explain this bit. I guess the point is that as a borrower, you won't always have access to a branch or, in fact, a real person to discuss things with.
So, you know, it's very easy to think that everything is going to go great with your loan. Until it doesn't go great, or it doesn't go great when you're trying to buy a property and the bank's not really, you know, they're not there for settlement and you need to talk to someone. Now, a lot of those online low-cost providers don't have access to any branches because of real estate. A lot of them, you even can't speak to a human. It's all via email or through chat rooms on their website. Now, you know, that's something that's sitting on hold for hours upon hours, waiting to speak to someone in offshore. is, that's your time, and that time has a cost as well.
Mm.
So just be mindful of those sorts of features. That convenience, you can't underestimate that when you're busy or there's a certain complexity to your loan.
Yeah.
Or you've got a deadline with a cool-off period and wanting to settle on a property within a certain period of time.
Yeah. Number 3, they don't always have the most up-to-date technology.
Yeah. So be prepared for a not necessarily the most up-to-date, advanced internet banking platform.
That's right. I was just thinking.
Yeah.
Yes. Yes. I remember actually, and again, personal story, that when I first started with a certain lender, their online banking was shocking, like it was Jurassic Park, people. They have since then, I'm still with them though, I've persevered. They have since then upped their game significantly. But it really was very clunky and very, be prepared for that. Absolutely. Number 4, I think something that is underestimated, fraud technology. It's generally these days, right?
The cheapest lender is not going to be investing the most amount of money in their fraud technology. And if you've ever had anyone try and hack into your bank account, or take money out of an account, you'll know that the larger banks or some of the more sophisticated lenders that have invested money into that have great fraud prevention strategies and teams that pick up the phone and say, was that you that took $200 out of your bank account? So that's just something to be mindful of, and it's not something you'll think about until it happens to you. But it does, and when it does, you'll be wishing you were with an organisation that wasn't the cheapest, but still offered a competitive rate, but is prepared to back you at that point in time when it wasn't your fault.
Right. Absolutely. It's happened to me twice.
It's happened to me.
Another lender that I'm with, it's more one of the big 4, they have picked up the phone and gone, hey, there's a bit of an odd, is this you? And one time it was, because I was overseas. And
the time it wasn't, they gave you back the money?
Well, they'd stopped the payment. They actually put it on hold. The payment didn't get processed. Until it was, or you get a text message to say, hey, suspicious, is this you? Stop to, reply, stop to stop payment.
I've had both situations. I've had the stopping, but I've also had the money move out of the account and the money given back to me. Thank you very much.
Yes. Okay. Potentially slow turnaround times. Again,
a lot of those low-cost providers are geared up, not really necessarily to handle an actual purchase with a time frame. And if it's a refinance, there is no sense of urgency to that. So while the rate might be attractive, if it's going to take you 3-4 months just to refinance, you could have been paying slightly more somewhere else in a more reasonable time frame, and reap those benefits a lot sooner.
Yes, absolutely.
See it all the time.
Yes. And this is all obviously a very much a common theme. We're really just running through all of those potential issues. So, but really the reasoning behind it, all of these is very similar. They're giving you a low interest rate for a reason, right?
And just, sorry, Kate, on that point, it's not necessarily just your online cheap providers. There are reputable lenders out there that perhaps have gone too aggressive with their pricing. So they've pre-approved a bunch of clients. And now at the stage of the market that we're at, everybody's coming back wanting to convert those pre-approvals, and they can't just simply hire new people.
That's right.
So what happens with that is the conversion of pre-approvals to formal take priority. Anybody else in the queue, if you're self-employed, like we talked about in the last video, or if you're just a refinance, you get bumped down the line because they just can't handle the volume.
That's exactly right. And they will prioritize the purchases. Obviously
they have to.
Again, I think it's really important to always put yourself in the bank's position here. Think about what they're a business, right? And I think case in point, did this not happen late last year when everything started to ramp up again? We had whole momentum that started to build September, October time last year, when everyone realized the world wasn't ending here. Property markets went crazy. The banks suddenly had, and there was a couple of lenders that had these magnificent special offers on, and they could not handle the volume. This is exactly what you were just saying. They could not handle the volume of business that came their way, and it took them forever to process the purchases, case in point.
Yeah. And we're seeing that at the moment as well as we come into the lead up to Christmas. With a handful of lenders that I'm like, look, their rate might be 20 points cheaper, but we're not going to be able to make settlement, and it means nothing. No. I think Westpac were in the media recently for a similar situation where they actually lost the property because they couldn't make settlement.
But look, at the end of the day, that actually almost happened to one of our clients too, you know, where exactly that happened. And you have got to keep in mind, everyone, at the moment, especially at the moment, there are predominantly owner occupiers out there, and they do have a lot of cash. You, perhaps as an investor, you know, you're gonna, if you come to them with, you're gonna need a month's finance condition to get your finance sorted. You don't want to settle before the end of January because there's no tenant in place, or for whatever reason. You are not going to be looked upon that favorably by a seller when you've got an owner-occupied offer that is perhaps unconditional or cash or just better conditions, because you've gone with someone with those very long turnaround times, etc., etc. That deal is going to fall through. You are not going to be able to secure that property. So what's more important here, right?
Yeah, 100%.
Yeah, I'm seeing that a lot at the moment as well. Right. Offset accounts, so having little whistles and bells attached to our accounts.
Often that the cheapest lender with a basic product might have a redraw feature, which if you're an investor and you don't have any owner occupied debt, a redraw feature is not going to be great for you from a taxation perspective. If you want to put your surplus money in, pay down your investment debt, and then redraw it back to buy a car or go on a holiday, your accountant's going to pull his hair out.
All sorts of hissy fits. Yes, exactly. I'm going to have hissy fits. Never mind the accountant.
So an offset feature is really important for investment debt, but also owner-occupied debt. Don't underestimate the ability from a budgeting perspective to have multiple offset accounts. Not every bank offers them, but I'm a big fan of those lenders that do. Having the ability to break up your budget, a holiday account, a bills account, extra loan repayment account, spending money, play money.
Dare we name drop the barefoot investor? But that's very much that
100%
of thinking, right? I'm not necessarily recommending it, but I'm just saying a lot of people do follow that. And having the option to, like you say, have those different offset accounts it does give you a lot of options.
A lot of financial advisors will recommend that. Myself, I've been doing it for years. And then read Barefoot Investor, went, oh, okay. So this is a common theme.
Very much so. So and me too. I've got sort of multiple offset accounts. You know, one's kind of tax savings, one's other savings, one's transactional offset account that, you know, all the money comes into, but still offsetting a loan. As
great as an offset feature is, having all your money in one account, it's very easy to dip into different buckets, unless you want to have a spreadsheet that breaks up every separate account, which I have had to do that. I was in a bank with only one offset.
Yes, you know, famous for saying there is nothing in life that can't be solved without a great spreadsheet. Okay. Can be problematic when or if you are applying for something or doing something that isn't absolutely bog standard, when you're trying to fit a square object into a round hole.
So you may be with one of the very vanilla low-cost operators that you have a pre-approval with them, and then you find this dream property, but there might be a nuance to the property. It might be unique. There might be something different to it. It might be in a suburb with, you know, an abundance of stock for that bank.
The bank might consider it rural. Whatever.
And then the bank says, sorry, we won't accept that, because any pre-approval is subject to satisfactory acceptance of the property and valuation. You might need mortgage insurance. You might want a parental guarantee. You might want a maternity leave policy. All those sorts of things may not be suitable for that low-cost provider. They have to cut costs somehow, and that's by usually, as we talked about, keeping real estate low. So that might be offshoring, or not having that branch network. But it could also be very simple policies that only deal with very simple PAYG, so that your skill level of your staff doesn't need to be that great as well, and therefore keeping your overheads down from that perspective.
No, I genuinely had never thought that one through either. The quality, the staff.
See it all the time.
Yeah. Yes, and this is why when I knew we were going to talk about this, I got so excited. Because to me, this information is gold. It is, Tina. Seriously, I think, if this video doesn't go viral, I don't know why not. Okay. And that, I guess, will then also all of these segue into each other, right? So potentially number 9, potentially an inferior approval process. What do we mean by inferior? Not just
it could just be, again, if you've got staff members that don't have a certain credit delegation, and what I mean by that is being able to sign off and approve on the loan, which usually you get from some level of expertise and experience in the bank. The bank then says, okay, well, we're happy for you to tick off and sign off on that loan up to $1 million, 80% loan to value ratio. But again, that requires an expertise with the staff, more expensive. So it may just be they have to go up to the next level to tick off on one slight thing that is slightly outside of the normal policy, for example. And then that might add another week or 2 to the process if they've got slow turnaround times and more bottlenecks every time you need somebody else to sign off on an application. And that's also not just for low cost operators. There's one major bank that is just renowned for having so many layers of approval that they come back to you, we need you to answer this question, another 5 days. Okay, well, once you've answered that question, then I need to send it up the line, and that's another 5 days. So those sorts of things, even when they say our turnaround time is this, if a good broker will know if that bank has a particularly clunky process, and if they're telling you that that bank is just very difficult to deal with, while the rate may look fantastic, that you may miss out on that property or that cooling off period or that refinance might just take forever. There are some lenders that won't let you order an upfront valuation. So you may have to go through that whole process for your refinance, for example, or your formal approval. And by the time they've assessed it, stamped it, ordered the valuation, your cooling off period's expired, or, the valuation may come in less and you can't actually refinance anymore. You've wasted all that precious time. So that's what I mean by kind of clunky processes in that regard.
Yes. And again, everyone, this insight into the behind the scenes processes, which vary enormously, to me is so useful. You really need to understand, what's that process that's happening when you're submitting these, not just the pre-approvals, but obviously when you're going for formal approval. You cannot assume that it's just, it's one person at a bank looking at this. Like you said, it's multiple people. The process could be clunky. Oh my God, Okay. Number 10, finally, the lender the lender and that rate might suit you right now, but that particular lender or product, etc., might not be able to grow with you and your portfolio. I see this a lot. I see this a lot too.
I do too.
And
it's usually, Kate, someone has gone online, found the cheapest rate, refinanced their home with ample equity, and then wants to buy an investment property. Now, the challenge, a lot of these online providers, if you wish to extract equity from your property, they won't give you that equity unless you actually have a contract of sale. Now, what that means is if you need to pay a deposit, you're going to need to run around and get a deposit bond or come up with the cash. But potentially you won't have that facility available for you until you've actually purchased a property.
And I have to just pause. I have to jump in there because trying to get a seller in this market to accept a deposit bond, good luck with that. No.
Often that particular investment loan needs to be principal and interest. It's often capped out to a certain percentage of the value of the property. So yeah, if it's principal and interest and you're looking for some investment debt, you've still got an owner occupied debt, your accountant's going to be suggesting potentially that you should have interest only on that. So just something to be mindful if you are looking to refinance to one of these providers. Try and think bigger picture of what your goals and plans are. If that involves buying an investment property, perhaps think twice about going to one of those providers that can't grow with you.
Yeah.
Probably on that point also, these providers often might have the lowest cost, but they may not give you the most borrowing capacity. And if that means that
that's point number 11. You've snuck another one in.
Well,
it
was actually number 5, I think, and I forgot to mention it. But it
no,
ties in.
Number 11.
Yeah. But essentially, if you are going to the cheapest, but you can't borrow as much, and that means you can only buy that 2-bedroom house instead of the 3-bedroom.
Yes.
The bigger picture is the cost of buying and selling property that you've only held on to for a short period will more than likely far outweigh any cost saving from a 10, 20 points on your interest rate.
Yes, sorry, you're right. That was a previous point. That their lending policies might be more restrictive, right?
Yeah.
That's the point that we
keeping it vanilla.
Yeah.
Higher living costs.
Yes.
Higher assessment rates, lower allowance of bonuses, commissions, so forth.
Yeah, and I think, like you were alluding to a minute ago, you're going to be able to borrow less. You're going to potentially, not always, but potentially buy an inferior property than you could have done.
Yeah.
It would. I think the real moral of the story here is, with a few of these points that yes, you might save or have the perception of saving a little bit of money at this point, but if it means you are able to borrow less money, potentially miss out on a few properties while there's amazing growth happening.
Yeah.
You're going to buy potentially an inferior property that won't grow as well in value. The opportunity cost to you, because you've been chasing that cheaper interest rate, to me is enormous of what you're sacrificing there because of potential short-sightedness, thinking ahead, looking at this bigger picture, perhaps not realizing what you are all these behind the scenes things, the restrictive lending policies, the longer turnaround times, all which are not necessarily so, but might be the case, and often are in our experience. So there is so much I could literally talk to you about this for the next 3 hours.
I'm very passionate about this topic.
I'm very much so. That's why I got so excited. But I really do urge everyone out there, please don't just chase a cheap online interest rate. There are massive repercussions to this, potentially, not always, but please talk to a broker first. Yes, like we're saying, we're not saying the interest rate isn't important. Of course it is. But you do want to balance having the right loan product for your situation that will grow with you over the next few years, that will enable you to do what you want to do and get you to where you want to get to in life, and still pay a great low interest rate.
Yeah.
Right. And I would assume, no offense everyone out there, but we're not all the experts that this lady is. Okay. So please keep this in mind. Talk to Tina before you do these things. It costs you nothing, in fairness, right, Tina, to use a great broker who knows what they're doing, who can assess the right lenders for you and get you a great rate. That won't mean that you come unstuck in 2 years' time because of chasing the cheapest rate out there with let's call them an inappropriate lender for you. It's the most tactful way I can think of to put it, right?
Yeah, absolutely.
Yeah. So, okay, enough on that, because literally I could be talking about this for the next 3 hours. So we will leave it there. Please, anyone who is looking to purchase a property, or if you know somebody who's looking to purchase a property, send them, please forward them, share this video with them. I think it's one of the most important things that they will watch. I know that sounds really arrogant, but I do. I'm very passionate about this. And we will continue on other exciting topics very soon. So thank you very much, Tina. Mind of information, absolute gold. Thank you.
Thanks, Kate.
We will see you all soon.
Okay.
Bye.
Bye.
I really hope that you found all of that useful. Tina is a mind of information. She and I will bring you lots more videos explaining all things property finance. Don't forget to leave us a comment and a question. And don't forget to hit the subscribe button, and also just give us a little like on the video if you are enjoying the free content. And we will see you really soon. Bye.